Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 84, we're going to continue some of our previous discussions surrounding the generation skipping transfer tax, shorthand known as the GST tax. And today we're going to dive into some of the basics of allocating the GST tax exemption. Now, there's a lot of depth to this subject and this discussion, so really we're just going to cover the basics today, and there's about 10 different ways we can take this for future episodes. So we'll keep those deeper questions on the table for now and just really look at the surface level of allocation rules and how they work and what you do with the GST tax exemption. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, as we've looked at in previous episodes, every individual has a GST tax exemption which is equal to their basic exclusion amount. And that amount is currently $11.58 million, but could sunset in 2026 if not sooner reduced by legislative action. Now, this GST tax exemption can be allocated to generation skipping transfers both during life and at death. And as we talked about before, generation skipping transfers are any transfer to or for the benefit of skipped persons who are two or more generations younger within the family tree, or if unrelated or distantly related, who are more than 37 and a half years younger than the transferor. Now, one important point with the portability election is that a deceased spouse's unused exclusion amount, the DSUI, does not include their unused GST amount. So if you make a portability election, you're going to preserve unused estate tax exemption, but you will not preserve unused GST tax exemption. As of now, that cannot be preserved under current law unless you do more proactive planning. Now, as previously discussed, the allocation of the GST exemption is the key to avoiding the application of the GST tax. If you allocate enough GST exemption, you can make a trust become GST exempt. But if it's not done correctly, then both the initial value of the transfer and any future appreciation could be taxable under the GST tax regime. But the good news is that the IRS since 2000 has implemented automatic allocation rules which can avoid the very punitive and sometimes accidental application of the GST tax. But if you leave automatic allocation up to the code and to the IRS, the valuation may end up being overstated, which could result in some wasting of your exemption. So in other words, you could end up using more GST exemption than you use gift or estate tax exemption if this isn't done correctly, amongst other things. And here we're going to look at the cost of an incorrect allocation. So we're going to assume that a deceased grantor had created a dynasty trust 30 years ago, which had an initial value of $600,000, which was the estate tax and gift tax exemption at the time, and that's now grown to $50 million. So great performance over those 30 years. Now, if no GST exemption had been allocated when this trust was funded, then here's what would have happened and would happen going forward. For one, every distribution to a skip person would bear a GST tax of 40%, and when all non-skip persons die within this dynasty trust, the entire balance of the trust, which currently is $50 million and could be more, will bear a GST tax of 40%. Now, these results could have been prevented with a simple allocation of $600,000 of GST exemption to the trust at the time of funding. Now, caveat, I don't necessarily represent that any of these historical figures are correct with respect to the $600,000, but you get the general point of the cost of not correctly allocating GST tax exemption. Now, in order to determine whether you can allocate, first you have to look at whether the trust is subject to an estate tax inclusion period. So generally, what that'll be is a greater than 5% probability that at least a portion of the assets of the trust would be included in the gross estate of the grantor or the grantor's spouse if either were to die immediately after the transfer is completed. So for this reason, a lot of retained interest trusts like the GRAT and the CUPERT generally can't be exempt from the GST tax, at least up front until that ETIP period ends, because ultimately, that asset could get included in the grantor's gross estate if the grantor dies before the end of the GRAT term or the CUPERT term. Now, it's important to note that a marital trust that has a QTIP election would be included in the gross estate of the surviving spouse, which could create an ETIP period, but there's an exception called a reverse QTIP election, which allows for the allocation of the grantor's GST exemption to a marital trust that's making a QTIP election, so long as that reverse QTIP election is also made for generation skipping transfer tax purposes. Now, assuming that there's no ETIP, you can allocate GST exemption as long as there's at least a negligible chance of GST potential in the future. So, since 2000, there have been automatic allocation rules within the Treasury regulations, and these apply regardless of whether or not you actually report the transfer to the IRS. So regardless of whether or not there's a gift tax return or an estate tax return filed, the GST exemption is automatically allocated first to direct skips and then to indirect skips that involve GST trusts. So we'll look at GST trusts in a minute, but for the time being, the amount allocated is equal to the fair market value of the transfer at the time of the completion of the transfer for gift tax purposes. Or if it's a transfer at death, it's the value determined for estate tax purposes, be it the date of death value or the alternate valuation date. Now, an indirect skip is usually termed a transfer to a trust where both skip persons and non-skip persons are beneficiaries. And in that case, you have no way of knowing how much the skip person will get until there's a taxable distribution or a taxable termination, as previously discussed in an episode on generation skipping transfer tax. But there's only automatic allocation to that indirect skip trust if the trust is a GST trust. Now, we can't go through the full taxonomy of what would be a GST trust here, but generally it's going to be one where a non-skip person doesn't have the power to withdraw during life or appoint at death through a general power of appointment more than 25% of the trust assets prior to age 46. It's also a trust that's not includable in full or in part in the estate of a non-skip person who would die immediately after the transfer. Now, there's some other issues. For example, a charitable lead annuity trust has special rules that must be taken into account. And if you have a trust that's subject to an estate tax inclusion period or an ETIP, even though you can't automatically allocate GST exemption to that trust, you can elect to treat that trust as a GST trust, which would result in automatic allocation of GST exemption at the close of that estate tax inclusion period. And that kind of brings us to the bread and butter of this discussion and kind of the top of the food chain of what a lot of practitioners recommend is that you elect out of automatic allocation and manually allocate exemption just to create some certainty with respect to the paper trail and valuation of assets to which the GST tax can apply. Now, if you do elect out of automatic allocation, you can manually allocate the GST exemption on a gift tax return. So in order to cut off automatic allocation, one, you have to file an election out statement with a gift tax return, and that can apply in full or in part to the transfer. It could even apply to future transfers, either in full or with respect to a certain trust. And if you want to manually allocate GST exemption, you also have to couple that election out statement with a statement of allocation of exemption, both of which are included with the timely filed gift tax return, including extensions. Now, at death, the executor would get first strike at allocating GST exemption manually, then any unused portion would be automatically allocated if not accounted for on an estate tax return. So there's lots of ways we can go with this in the future. Future discussions will include looking at crummy rights and how those affect the GST tax allocation and other sorts of issues like that. But for the time being, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.